You have said that the economy is well on its way to being back. How far back are we? Are we all the way? Do we have some distance yet to go?
Well, David, in the macro sense, first, thank you for having me on, and it's good to see you again. In the macro sense, most people predict the economy kind of crosses over the 19, where it was 19 before the pandemic, sometime in the third quarter type of things. And that's important to realize, because then it's predicted to keep growing for the rest of this year, 5, 6, 7%, and next year 5%, which is much different than it was at that size in 19. And so, the challenge is we've been fighting a war on a virus in society. We are winning, but it ebbs and flows. And if we can keep the virus under control, I think you're hearing it in everybody's commentary, we're set up for a strong growth rate for this year in the aggregate and strong next couple of quarters. The economy is big. The Fed in the U.S. is very accommodating, as central banks around the world, and then next year is predicted to grow more. There are parts of the economy which are still crossing over. We said today that domestic flights booked on our credit cards were up 8% in the second quarter, but we said international flights were down 40% from 19. So, there's still pieces that are working its way through, but unemployment rate's a little high. But overall, the economy's in pretty good shape and predicted to grow. We just got to make sure it holds through this last, or hopefully the last surge of the virus of these new variants.
So you have a unique vantage point into the American economy because of your business, particularly in the middle market. You have so many customers, so many consumer and commercial customers across the country. Do you see any potential headwinds? Do you see any potential risks right now to that recovery?
Well, there are a couple things. One is it's the vaccines, the virus, and the variants. That's the key. So if we keep winning that war, hospitals stay in great shape, the treatment regimens keep coming on, and then more and more people get vaccinated, lowering the risk of serious sickness. That is all great news. That's the main one. But on top of that, you're hearing our small business customers, for example. We surveyed them last fall. It's all about the virus. We surveyed them this spring. Workers, supply chains. And that you hear more from people, whether it's the ports not being fully open, whether it's the goods and services not coming out the rate as viruses resurge in some of the manufacturing places. And that's where you're seeing some of these temporary spikes in prices and, frankly, just availability. So I think as we move to the fall in the United States in particular, the biggest constraint, other than, frankly, the virus pathway itself, is going to be the question of, can I get people to do the work, and can I get the goods to actually sell? And that's what we hear from our customers. They're worried about. Those are farming customers who can't get people to work. And the harvests are coming up. That's construction workers. That's truck drivers. It's all the above. And so we need to make sure that we get people back and mapped into the jobs and get them the skills and continue to provide a great career for them, but also help the economy grow.
Brian, as you know so well, there's sort of a raging debate in this country now about inflation. Everybody agrees that it's here, it's coming. They don't agree on how long it's going to last. From your point of view, are you seeing any indications of a slowdown in economic activity because of higher prices? Do you see some of your customers, for example, pulling back because of inflation?
No, not from a standpoint. You don't see them pulling back yet. That's the operative question. Operative word is yet. And so right now you're seeing consumer spending rose in the second quarter at a faster growth rate in a record aggregate amount compared to the second quarter of 19, not 20, but 19. So it's basically 20% higher it was plus in 19, which means 10% for 2 years. So that's a big amount, growing faster, record levels. So people are spending money. So prices aren't affecting them yet. Now, when you go and look at our auto dealers, they can't get cars to sell, so their draw rate in their lines is a low level, i.e. they aren't financing their inventory because they just can't get cars to sell. That's why you see in all the ads. And used car prices are going up. That will have an impact on people over time. But the belief is that's transitory and will come back out once the supply chain for new cars gets done. And when people buy a new car, there comes an old car. And remember, used cars are 2 or 3 times the sales levels as new cars in the United States. So there's a part of this that just needs some work to get through the system, whether it's a chip shortage or some of the other shortages. But right now, it's probably pretty much temporary, but it is there. It's not like it's mysterious whether inflation is going to occur. You can see it in the numbers today. The question is, in 6 months or a year from now, where the expectation is that it will keep going, as opposed to people are used to that, wages have risen, prices have risen, people can pay it. It's not slowing down their behavior, a precise point. But that's not even the most important thing now, it's actually over the next 6 months. Think of wood prices. Your colleague just talked about the prices going down. A month or two ago, we were talking about outrageous wood prices, and now you're talking about them having come down. So I think that's the debate. Are these things transitory or not? But it'll be 6 and 12 months ahead as the Fed sees that. They may stop some of the accommodation before that, but that's what they want to see, is that fundamental expectation of inflation stays high enough, but not too high.
So that is the question. We believe, many people believe, the inflation is transitory. Others disagree with that. What about these record low rates? And for that matter, stimulus in terms of bond buying by the Federal Reserve, that must surely be transitory. What kind of period are you expecting in terms of when they start pulling back on that monetary stimulus?
Our research team has the bond buying kind of starting to move away in the latter part of this year and early next year, and rate moves really later past that. My guess is they'll be moving that in based on some of the data that you're seeing come out, or earnings reports and activity, again, assuming the virus doesn't move. But, I think the market made a big step of moving in the rates based on the last sort of Fed input and Fed results. But I think, the market's going to ebb and flow based on what the data they're seeing. And so our belief is, frankly, that the economic conditions are such that it would be, the Fed needs to be accommodative to assure the war on the virus is won. And that's when 6% unemployment gets to 4%, when, wage and prices have risen, but then have slowed back, have risen in a fundamental way that they know there's not deflation ahead or a problem with demand, then they'll start moving. And the expectation is the first thing they move on, not the expectation, the decision is the first thing they move on is balance sheet, and our team would say end of year, early next year.
So, Brian, you announced earnings for Bank of America today, and certainly some of that recovery in the economy was expressed in your earnings. You have $9.2 billion of profit in the second quarter. Pretty nice big number, I must say. At the same time, you have consumers who are really strong. They have a lot of cash on hand, but you don't have loan growth. Is there anything that you at Bank of America can do to stimulate loan growth, or do you just have to ride it out and hope it comes back?
Well, there has to be loan demand to get loan growth. And that, going back to consumers, say credit card balances, what happened is consumers got a lot of money through the stimulus. They quit spending money, and that gave them money to pay down their card balances. We have just as many cards today as we had 2 years ago, and we have $25 billion less in balances. But they started building up again in the second quarter. The commercial loans, the same thing. We have just as many, more clients now than we had 2 years ago. But the draw rate on loans was 41% then and 31% now. That's $40 billion. But they started to draw more. They started to do more in the months of the last quarter. And so in each month got bigger. Our business banking, which is 5 to 50 million companies, started to finally grow. Our small businesses producing more lines of credit and more credit originations than it did in 19. Those are signs that you're seeing the loan growth come. And at end of period, you saw us grow loans by $15 billion, even with the PPP runoff. And that's good news. Now we got to see that just keep compounding back up. If you go back about 2 years, we were $980 billion loans. We're at $915, $920 now. So we've got some room to go just to get back to where we were. But it's going to come down to customer demand. The way banks stimulate credit is to make credit too available, and then they don't like it after. So you have to stick to your responsible growth and do it the right way. And that's what this industry, frankly, the whole industry's done, and we've been a leader in the industry. Our charge-off rate today was the lowest it's been for 25 years, and the company was called Nations Bank then. That's how far it goes back to where the last time we had a 27 basis point charge-off rate.
So loan growth is returning, and as you say, it depends on what happens for the rest of the year. But let's assume it stays on the path it is right now. Where does that put Bank of America at the end of the year on loan growth?
Well, we should pick up, as the economy normalizes, we always say we should outgrow the economy because of getting market share by 1 or 2%. The problem is you have a recovering economy, it's growing faster. So, if you analyze the $15 billion, that's 2%. You can see the number there. We'll see it. But we expect mid-single-digit loan growth in more normalized times. And again, that all depends, in some respect, that we've got to make sure the economies stay open, the businesses stay open, and frankly, the supply chain of things and people gets straight, continues to improve, which every expectation is. The people who thought it was bad 2 months ago feel a little better now, and we're seeing it get incrementally better, but it is still challenging.
So that's loan growth. Let's talk about trading, because trading, I think the way I read it was something of a mixed bag. On the one hand, fixed income disappointed some people, your trading performance in the second quarter. On the other hand, equities sort of shot the lights out. I think it was like 33 or 34% up. Let me start with that one. What did you do to get that result?
Well, the team The team under Sufyan and Jimmy have done a great job in the trading area, continuing to gain market share with clients, using a little more balance sheet constructively to help those clients and in some of the prime brokerage areas and stuff. They've just done a great job. And so we are up higher than the peers so far, and we'll see what happens as the rest of them report on equities. And we were kind of in the same ballpark, 38% down on fixed income. But we run this business to be consistent across time. 21 first half, bigger than 19 first half. 21 first half, sort of metza with last year's first half. So we're trying to run this thing in a long run just to keep making money. We didn't lose any money on any trading day last quarter. Tom Montag and the team do a great job. And it's just, you just grind it out. And we help clients, and we make some money. And so you're not pushing too hard, so you have to pull it back. And other people go different ways, but that's our philosophy. We are fundamentally building that business up a little because the market share has been growing, and frankly, it shrank as a part of the company's size because the rest of the company grew, and now we're getting that back into orientation. It helps you optimize the capital and other things.
Brian, you mentioned prime brokerage. That's gotten a lot of press recently because of some other big banks who've gotten their fingers burned, I think it's fair to say. How much did Bank of America benefit because some other people had to pull back in prime brokerage?
Well, I assume we did. I don't have any specific statistic, but it's a hard business, and you got to know how to do it, and the team does a great job, and the risk team supporting them, Jeff Greener and the team do a great job, and so we feel very comfortable with it, and the truth, and it proves out. But it's not an easy business, and you got to have a lot of technology, a lot of risk capabilities, and you got to have very good people running it.
Brian, in your earnings statement, you called out particularly Asia as really helping an awful lot in your equities trading business this last quarter. Give us a sense of Asia and the exposure there, because there is some controversy over in Asia as well. How exposed is Bank of America over when it comes to equities trading in Asia?
Where the controversy is, and that's the controversy hasn't affected us. We have Japan, and we have Hong Kong, and then we have mainland, and it's not a huge part of this. It just it grew nicely last quarter, so that's why it was called out. It's in the below 25% of the business around numbers, but you got to remember there's different parts of what we call Asia that are part of that controversy. So the Hong Kong team does a great job. We have a more limited business of serving large companies and cash management on mainland China and Hong Kong. Obviously, we have equity trading and things like that, and it's been doing fine.
Yeah, Hong Kong's been in the news just about every single day here. Are you contemplating any possible changes in how you operate in Hong Kong because of the controversy there?
Not yet. We'll see. The team does a good job. They're dealing with the virus and everything else, but obviously we obviously keep our eyes close to the ground, ears close to the ground to hear things and make sure our team is taken care of and doing the business and being safe and everything. And we'll see. But the operating countries around the world is always interesting, and it will be. Some other countries someday will have the same conversation about, and our job is to actually support our clients and do a great job for them.
Brian, in the investment bank, I noticed in the earnings call that I think you had the third highest quarter ever on your investment bank revenue from that. At the same time, some of your advisory fees were sort of flat, where some others were really going well, because there's a lot of M&A going on, as we know, a lot of mergers and acquisitions. Do you feel comfortable that Bank of America is fully competitive when it comes to those mergers and acquisition fees?
Yeah, well, you have to think about investment banking as a broad set of capabilities: debt financing, equity raising, and M&A. M&A is generally the smallest portion of the three, and we tend to have always been dominant in some of the debt underwriting and very strong in the equity underwriting. So our M&A never looks as big. But we had $2 billion of fees. It was the third highest quarter ever. Missed the second by $7 million. The highest was the first quarter this year. Matthew Coder and team have done a great job, and so. While other people may have more M&A fees, we had better debt financing fees as a percentage, and it's our clients and what they're doing, and sometimes you're in the M&A flow, and sometimes you're not. Sometimes you're in the financing flow as part of the M&A and not in the M&A fee. But all things being equal, the team's done a great job under Matt's leadership.
One of the key roles that I've learned over the years of a CEO is allocation of capital. You have a fair amount of capital to work with right now at Bank of America. Give us your sense how you're approaching the question of paying dividends. You've had a policy, I think, of about a 30% cap on your dividends. Are you reevaluating that? How are you deploying your capital now?
Well, we announced a few weeks ago after the CCAR test for this year that we were going to raise the dividend by 17% from 18 to 21 cents a quarter. The board has to approve that. We're going to recommend to the board, and they would approve it formally at their next meeting. And then now, after starting July 1st, after that, we can now buy stock back, not based on the constraints that were in place before, which was 4 quarters trailing income, take out your dividends. And so we believe in that 70-30 split, and we're moving the dividend up. And then we're buying a lot of stock back because we have 200 basis points of capital over the minimums, and it was capital return interrupted by the pandemic. We shut down for a couple of quarters, and then we finally got into it. But by then you're using the average of 4 quarters earnings, and the earnings were building back up, and we put the reserves up, and so it was a constraint. And so I think we bought $4 billion of stock back last quarter. You should expect it'll be more this quarter because we've come through the crisis, and we just have more capital than we need. And part of the way that we do is we take care of our clients' needs, and we make sure we serve those. We spend the money on what we need to spend the money on, and then after that we produce income, and that income all goes back to the shareholder, and then the capital that's built up from earlier income that we couldn't get back is going back soon.
In the earnings call today, your CFO actually said something interesting, saying we are not a hedge fund. It never occurred to me you were a hedge fund. But are you investing in other securities besides buying back your own stock? How are you deploying that cash that you're keeping in your reserves?
What he said, there's actually a time period 15, 20 years ago in this company that somebody accused the CFO of being a hedge fund. What we mean by that is, look, we generate deposits from core transaction accounts and core relationships with customers. We don't have hot money. We don't raise money by deposit pricing. Our deposit rate paid at a few basis points, literally. So those core deposits then are because we have great client relationships. Then you have to turn around and do something. There's $1.9 trillion of deposit. There's $900 billion of loans. That's $1 trillion different that's got to be put to work. And so what we do is we put it to work to extract the value of those deposits for our shareholders, because that's the way you get paid for deposit relationships, is to invest them. So invest in treasuries or invest in mortgage-backed securities, no credit risk. And the debate is, do you time it or try to do things? No, we just constantly invest when we're assured. In a world where you had massive liquidity hit the market, when you're sure that those deposits are attached to real customers are going to stick with you, you start to deploy it. The work that Paul Donofrio and the team have done, Andrew Magazine, our treasurer, and others, is over the last 3 quarters, our NII has held flat. And we called a bottom last year, 3rd quarter, that people didn't think we could because of the asset sensitivity of the company, and it's been true. And it'll start to grow now as loans grow and continue deposit growth. But we invested some of that capital to start to get the value of those deposits. And we invest some floating, some fixed, et cetera. But there's a lot of complexity to it. But they've done a good job of starting to extract those deposits. Meanwhile, we have another $100 billion of deposits linked quarter growth, and so you got to put more money to work.
Brian, let me turn to something that I know is near and dear to your heart, and that's your digital efforts, your digital business. And you're putting up some really big numbers in terms of the number of digital clients, the number of transactions, all those things. But make some news for us here today. What's the thing we don't know about the digital operations of Bank of America that we should know?
Well, one of the ways is to have to see how the digital is part of the high-touch, high-tech attack. And so people get focused on mobile active customers or digital active customers. We have lots of those, 45 million. We're number 1 ranked in those things. That's all good. But what you forget is it's tied to how you build out the franchise. So if I were talking to you 6, 7 years ago, I would have told you that in the top 30 markets in the United States, which is half the population, we weren't in 7 of them. And we were number 1, 2, or 3 in the other 23. Today, we're 1, 2, 3 in 25 markets. So we've improved on some of the markets that we weren't 1 or 2 in. And we did that through digital and deploying the branches. So what's interesting is we're gaining market share by using digital-led execution. So in Pittsburgh, we had tens of thousands of checking accounts that signed up with us before you ever opened a branch. Same thing in some of the places in Ohio. So that digital allows us to expand our branch franchise much more efficiently. And so we have 4,300, 4,200 in some branches today. We have $1 trillion deposits in the consumer business alone, and another 200 or 300 billion in the asset wealth management business, and then also the middle market stuff, which depend on that branch structure. It is the most efficient branch system. It's 20% smaller than a lot of people and has more deposits. That is because the digital allows you to do that, but also allows you to go attack markets. And that's why we opened Lexington, Cleveland, Columbus, Cincinnati, Indianapolis, Denver, Minneapolis, and Pittsburgh. And we just keep putting these out there, and we can do it with our combined digital efforts high touch, high tech. That's the interesting thing. So yes, you get more digital sales. Yes, you get more activity. And the other big thing, beyond just the attack you can do with it, is it also goes across the platform. So you saw the amount of digital engagement go up in our wealth management business go up a lot because of the necessities of the pandemic, and that's holding and even growing faster as we're entering the face-to-face meetings. Same with the commercial businesses. So this is providing a capability for us to just grow from. And the digital customers interacted almost 1 billion times in the consumer business last month alone. Just think of that, how much they're looking at us and interacting with us and doing it. That's brand quality, and that's why our customer scores are the highest they've ever been. Our brand is the highest they've ever been in the middle of a pandemic.
Yeah, extraordinary, extraordinary. Despite all the digital's done for us, a return to the office is a big topic for all the big banks. I know you set September as a goal. You said you want people back who are vaccinated. To what extent are you getting information from all your employees about whether they are vaccinated? Are they resisting even giving that information?
No, we asked people starting a few months ago, load the vaccine tool, upload your card, and because we needed that proof to be able to plan. And so we have about 75,000 U.S. teammates have loaded in, about 12 or 14,000 outside the United States. And so we're grinding away every day. Another 500,000, 500 or 1,000 or 1,500, are starting the vaccinating process because we can see it initiated because they start to load and then one's completed. And so you're just doing it. But that's like 50,000 people we have to move from home to the office. So we're basically busy right now. So we've said July, August, and September. Gave them a tool to say, pick which month you want to come back. They're picking that, some coming back immediately. And we had a town hall today in person with people. It was wonderful to see some of my colleagues I literally haven't seen since February or March of last year. And they saw each other. And so we're trying to get the people back, but we're also attentive this summer that people may have made arrangements to work, someplace and we can't pull the rug out from them. So we're letting it work and then we're getting them back. And then after September, I think it's September 9th, the balance comes back. And by the way, between now and then we'll have another, think about it each week, if a few thousand that we've got to, again, arrange for them to come back. And it's a complex task, but the people are coming and they're happy. They like it, and they're doing it, and we're opening the buildings. Our mail offices are going to be open by the end of the month, pretty much fully. Private bank offices, commercial banking offices, our branches are basically up to the staff, up to the number of levels we'll have coming out of the pandemic, and so it's all good. That's helping downtowns. I'm here in Charlotte today, and we need the people to get downtown to keep the restaurants and businesses going. And if they're vaccinated, it's time. We're telling them to come in and let's get started.
Brian, one more hot topic right now with respect to banks, and that is the reported burnout of some of the junior bankers. You've already said that you're increasing the compensation for some of your analysts and your vice presidents. Are you having trouble retaining people, particularly some of the junior talent?
Not really. It's just, our turnover rate in the company is basically what it's been traditionally. The thing about these kids coming out of college working for us is, they get a lot. They're very talented kids, especially around the investment banking area. And there's a lot of offers from private equity and other things that we're training them for our clients, and that's okay too. But we just had to keep adding people, and then you get busy, and then the work comes. And so we've tried to keep our teammates, keep level balanced, stay mentally healthy, stay physically healthy. And we think getting them back to work actually is a major part of that. So we're starting to bring those colleagues back. If you think about it, we have in investment banking and trading, and more broadly in the company, a class from 19 that was in the office for maybe 5 or 6 months, a class of 20 that was never in the office, a new class coming in that interned with us last year, but hasn't ever met their boss. And so we're doing it, and here they come, and they're talented kids. And some will find jobs elsewhere, but we've also told them, you got a career here at Bank of America, so don't worry about going back to business school. If you want to do that, that's fine. If you want to stay with work with, you want to work in a different part of the company. So we're just basically saying this is a heavily talented, 50% diverse candidates, great group of kids from the great schools. Come in, enjoy the company, and learn. But frankly, we got to get the culture wrapped around them, get them a chance to see each other. And some of the informality of that is just really tremendous. And it's not been able to be had because of the, frankly, because of the pandemic. And now we're reversing that out.
There's a fair amount of talk, and yes, writing indeed, about whether this pandemic has really changed the relationship of employees with employers. And a lot of people are saying, you know what, I've had a new thought about my career. I'm not going to go back to my old job. Do you find that you've weakened any of the bonds between you and your employees because of the pandemic, just because they've gone off to other things, had different experiences?
I just told our teammates, we take a survey every year, David, and we just had the results from 90,000 people filled out the survey. And last year they went to an all-time high. This year they are higher than they are by 19, and they're not quite as high as last year because that was a number that I think had to do with just the world we were in. Think of May 2020. So we went from 85 to 88 across from 19 to 21, which, that's what people are telling us. Now, are they interested in having a dialogue and trying to understand the dynamics they learned about commuting lengths, and is there flexibility about I can work some days in this office, some days in that office because I live someplace. Think of New York. We got Stanford, we got Hopewell, we got Jersey City, we've got Red Bank, and the idea is maybe I don't come into the island of Manhattan if I'm not. That's not a job requirement, but we'll figure all that out. The first thing is get people back and get them into the office and get them used to seeing each other, and then say, okay, let's talk about what you need to do or what you want to do. Meanwhile, if they have children, we have backup child care and we have child care benefits. Meanwhile, if they have, other things that we've had, arrangements for people to work part-time, full-time, flex time in the office, out of the office for years. And then our sales teams go out and see clients all the time, so they're always out of the office. So it's going to be a very different set of answers for their different groups of people based on the business needs and the teammates' needs. But we just got the survey results, very pleased with them, and second highest score we ever got, and higher than any score by a lot, 5-7 years ago, and so the team must feel pretty good. But we always are working on making it all work better for us.
You're always working on it, but just very briefly at the end, Brian, what do you think is the number one thing you did to create that kind of loyalty?
It's the team that works with me. We have fantastic people. Yeah. And we try to take an employee-centric, customer-centric view, the benefits, the things we do. But it's really just about giving them a chance to do more here than they can do otherwise.
Okay.